Hello, welcome to Financial Insider Weekly. I'm your host, Michael Gray, CPA. My guest today is Jim Quillinan, who is an attorney and shareholder with Hopkins & Carley in San Jose. They're a prominent law firm here in the town that I'm in. And he is the chairman of the Family Wealth and Tax Planning Department in that firm. He's been practicing law since he graduated from Santa Clara University with his law degree in 1974. Jim is highly respected in the legal community and is a frequent lecturer and author for the State Bar of California and continuing education of the bar. He serves as special master and referee in Santa Clara County and San Mateo County Superior Courts in complex trust and probate matters. On a more personal note, Jim loves to go to the movies. His movie reviews are very popular, and you can sign up to receive them by email for free at www.hopkinscarley.com, and you'll be seeing that coming up on your screen from time to time. Another thing that I learned today, though, that I think is pretty exciting because I'm in such good company, and that is that Jim has been a guest on David Letterman's show. So, gee, wow. I'm in good company with David Letterman also has interviewed Jim. Anyway, today Jim and I are going to be discussing planning issues related to real estate change of ownership in California. This is an area that a lot of people don't have any clue about, and so we wanted to give you some information about it today. But again, I want to caution you that this is just an introduction. This is a very complex area, and we want you, though, to become a little bit aware of these issues for a further discussion with an attorney or other tax advisor who is familiar with them. Also, we will say, though, that this isn't an area that's discussed regularly in the tax consulting field. You don't see it every week at the bar meeting.
No. You're hearing more about it recently.
Okay. So with that, Jim, let's get into our questions. Okay. And again, thank you for being with me today.
Oh, my pleasure, Mike.
Yeah. So first of all, why should California residents who own real estate be concerned about change of ownership rules when doing income and estate tax planning?
Well, it has to do with way back when good old Prop 13 was passed. I believe it was 1976, 78, somewhere in there.
78, I think it was.
And what it basically did is it locked in all the values as of that time, the assessed values, which were fairly close to fair market values at that time. And the assessed values couldn't be increased more than 2% a year. And what's happened is a lot of people have assessed values for their real estate that is considerably less than the fair market value of the property. So some properties will have very, very low property taxes, and the one right next door may have very high property tax because basically the rate's 1% of the assessed value. And along with Prop 13, there was a concept called change in ownership, which was it's been set up in a statutory scheme in the Revenue and Taxation Code. But a change in ownership is just what you might think it is. It's any transfer of that property to somebody else. Is a change in ownership, generally speaking, which will trigger a reassessment. So if you have a house that's currently got an assessed value of $100,000, but it's worth $1 million, and you sell it, the new owner's assessed value is $1 million, and their property tax is a lot more than it was just before. And so that will trigger a reassessment. And so we have to look at, are there ways around it? Because there are some exceptions to the rule of what is a change of ownership. And once again, they're set forth in the statutory scheme of things, but there's lots of traps for the unwary and lots of problems if you don't do it the right way. And probably the easiest one that we deal with every day is if you transfer property to a revocable trust or a trust in which you have the ownership rights, that doesn't trigger reassessment. Transfer between spouses does not trigger reassessment. Transfers from parents to children has some special rules I'll talk about those in a moment, that may or may not trigger a reassessment because it's not blanket like the other ones are. There's also a special rule for transfers to grandchildren under very limited circumstances, but that can happen too. But if you think about it, when your property tax bill goes up, it just doesn't go up once. It's the gift that keeps on giving. It comes back every year at that higher level.
Right.
And I must admit, every time I see these transactions go by and you see somebody that has a $10 million house and you figure out 1% of $10 million, well, that's a $100,000 a year property tax bill, minimum. And so these bills can be rather large, and that's every year. And we have had in the last, I'd say about 5 years, a significant amount of work in the office dealing with property tax issues and trying to get it done right. And there are ways to plan around it to make it work in a way that's effective for the family so that they don't get these huge property tax increases. And as I say, the easiest one, obviously, is you leave it all to the surviving spouse. That's the easiest one of all. In terms of if you just leave it to her, him, her, it's not a problem. It's an interspousal transfer. Let me talk a little bit about the parent-child, because that one's kind of interesting.
Okay.
The parent-child exclusion has a couple of rules associated with it. The first one is that you can leave the principal residence of unlimited value to a child or children, and that's exempt for the principal residence. The second rule, the parent-child rules is that you can leave up to $1 million of assessed value, not fair market value, but of assessed value to the children. And so that gets kind of tricky because you might have an apartment house that's been owned for a long time, and it might have an assessed value of several $100,000, but it's worth $10 million. And then being able to allocate that is obviously a huge benefit in terms of that tax cost. But now here's the next problem that you get involved with in terms of the parent-child exclusions is, let's just say we did leave the principal residence to the children, but only one child wants to live there and the other brother and sister don't want to live there. So how do we get the whole house to one child and have it qualify? Because if you look at the transaction, it really went to all three children. Now, if one child ends up with the house, those other two are deemed sellers back to the other child, and that's a sibling transfer. That's not exempt. So you would end up with 2/3 of the property with three children getting reassessed. Well, you can avoid that, and this is where somebody knows what they're doing is very important to get involved, because you can refinance the property inside the trust or inside the estate so that you can then distribute the money to the two kids that want the money, and you distribute the house to the 1/3 child subject to the mortgage. That will work, but that's a very tricky way that it has to be done just right. You can't have the child that's going to keep the house put the money in. It's got to be a third party. It's got to come through the trust at the trust level. Otherwise, it'll be deemed a sale by the siblings or among the siblings. So that's tricky. And the same rule would apply if it was not the house in that $1 million special rule that's out there. So this is where, if you're dealing with transfers of property after someone's died in and out of a trust, make sure you get to somebody who understands how the property tax rules work. Now, the other one that we use with some degree of regularity has to do with entities. You can create a family business, an LLC, a family